delving into stocks, property, bonds, economics, and more. This is the Stock Market Mentor podcast. Taking an unconventional stance, we challenge the industry to help you protect your investments and empower you with the knowledge to become a savvy investor. We don't provide financial advice. Here's Steve Moriarty, Tom Hill, and Jacob Sr.
Hey guys, welcome to Stock Market Mentor. I'm here again with Tom Hill, Stephen Moriarty. How you doing, gentlemen?
Good, mate. How are you?
Yeah, I'm good. Thank you. Today we're going to talk about something that gets us really excited because we can complain a lot, I reckon. So we're going to talk mainly about we're going to talk mainly about signal versus noise and how the industry keeps things all noisy. A couple of things we're going to point out is how it all relates back into the time theory and incentives. Three things that we always go back to when we're thinking about investing. And I think a really important point to start with really is how investing's changed over the years. The industry's changed so much, and now there's a constant flow, 24/7 access to just people barraging around why you should buy, why you should sell. The stock market's moved 0.3% and what that means to the global economy and all sorts of nonsense that we want to just really highlight. And hopefully there are a few beginner investors that are looking at this thinking the same thing. They don't know where to look anymore. I mean, so we've been in the industry for a while now, and Steve's been around for a long, long time, and even we slip up. So even we slip up and go, oh, this person said this on Twitter. And I think it's important we just highlight that, and then ultimately, what signals do we look for, and how does it help us in our investing career?
Yeah, I think it's interesting, me being the oldest here, it really is a lot. It really has changed a lot, even over the 25 years that I've been involved. When I first started out, I put money with a financial advisor who put it into the market, and he sent me monthly a paper sheet which said, here's how your stocks are doing. And, at that stage he had me invested in, a small cap index fund and, that sort of stuff. Mm-hmm. So it wasn't like, here's the, 70 stocks I invested in. But my point being, I received that every month, and it was, Steve, you had $12,000, it's now worth $13,500. And I remember thinking, wow, this is really good. This is excellent. But the point being, that was it. The other 29 days or 30 days of the month were like, yeah, cool. And then I'd just go off and do my day job, right? But the point being now, with the internet, it is an absolute 24/7 world. And the example I like to give to people is, if you have a think about this, the trading day in Australia starts at 10 a.m. and it finishes at 4, right? So during those 6 hours, you can buy and sell stocks. Now, at 4 p.m, you can have a cup of tea, you can come back around 5 or 6, and then you can start doing the British and European markets, right? Now, if you've got a global platform, and this is not a recommendation, but if you use something like Interactive Brokers, where you can trade whatever market whenever they're open, then at 7 p.m, you can go to the British market and say, hey, I'm going to buy some stocks in the British market. Then you can take a nap. If you get up early in the morning, 5:30, 6 a.m, you can catch the end of the US market, right? And say, oh, well, now I'm going to sell some of my US stocks or whatever. But my point being, you can actually trade or, dare I say it, invest 24 hours a day across all the global markets. Now, when I first started, and that was only, this is only 25 years ago. I know that sounds a long time, but it's not that long really. No. You actually say none of that was possible, right? There was that just wasn't doable. And so that has opened up what we're going to talk a bit more about today is this signal versus noise. And as you mentioned, Jacob, we want to bring it back to these themes about time and theory and incentives. And the incentive is driven by making that noise for people to buy and sell. And I'll just relay this little story, which I've probably said before, but, there's a junior trader. He's on the trading floor, and the market, the day finishes and they all clap and carry on, right? And the junior trader says, well, why are they doing that? The stock market went down 2%. And the old guy says, doesn't matter whether they're buying or selling, right? And what he means by that is we're making money whether they buy or sell. It's not about, saying, oh, look, everybody, just, like we mentioned, I think, in the last episode, nothing to see today. Anyway, see you tomorrow if there's something to talk about, right? Because the idea is, today the stock market moved, blah, 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 because that's what they want. They want you to go into your portfolio and go, oh, well, hang on, I better have a look at this, or, to something like doing that sort of stuff. And just to continue on there, the thing with time is with the internet now, you can day trade. There are intraday 10-minute increments, so you can buy a stock at 12 o'clock and sell it at 12:02.
It's so easy to jump on your phone on whatever app is available, put $10,000 in it at midday, and then at 3 o'clock you can take your winnings or your losses, and it's a click of a button.
Yep.
It's almost as far to say gambling at this stage, I would say.
Well, it is, but it's, you're right. It actually is. It's it's pure. You look at what went on with the meme stocks, and and with crypto.
Yeah.
The movements responding to information was absolutely huge. With those meme stocks, they were moving triple figures a day.
What was the one in America where they
AMC?
They just pumped it through the roof.
GameStop.
GameStop. Yeah. But that's a perfect example. 50, 60 years ago, that was just not really doable, right? Because you couldn't get the information to a broad enough range of people for everyone to go, oh my God, let's all sell GameStop, or let's all buy GameStop.
Let's manipulate the market together.
Yeah. Well, and that's a good point, Tom. Yeah. Right? Because there were young guys getting in and saying, let's do, let's short squeeze, right? I.e., let's force them to buy the stock and off us. So it becomes a real casino.
The fact that people have access to be able to band together on something like Reddit, and decide to short squeeze a huge company is just terrifying, I think, personally. But it happened.
Well, it's again that advent of technology, but also what the industry does is looks for the way to make money out of those themes. Right. So, for example, marijuana becomes legal. Suddenly there's marijuana ETFs, right? And marijuana is going to be a $4 zillion industry, right? Hell, I better get into those stocks. And then as fast as they go up,
they come back down.
They come back down again, right? And that's where you say, well, that actually wasn't a long-term investment. That was a short-term speculation. If you know that, you can at least say, like I think you said last episode, Tom, where, it would have been, I really should have taken my money off the table as it was rising.
Yeah.
But to do that, you've got to say to yourself, I know I'm speculating here. So I'm just going to grab the money as it's there. I know I'm not going to maximise it, but I'm going to walk away with 200% rather than say, I could have made 4, but instead I made 50. Right? Because you were doing you had the timing wrong, plus you didn't realise that you were speculating because you thought you were investing. And it's what, as an older investor, it's what I see a lot happens, particularly with young guys, right? They get involved, it's GameStop, it's ANC. Some of the stuff I've seen the last 2 years where young guys are saying, I'm down 300,000 in a margin account. You just look at it and go, that must just be a nightmare. But the market just keeps churning on. It's like, okay, well, Jacob's dead. Next, let's just get someone else in here to, start doing the same sort of thing.
Yeah.
And that's what, hopefully people are taking away from this podcast, is being able to say, they're the things I got to watch out for so I don't get lured in, right? And instead of saying, I'm going to get rich by doing X, what they're hopefully saying is, I know the tricks and I know how to avoid getting suckered into those, or by saying, I'm going into this with my eyes wide open and I know it's a speculative investment, and if I do my money, fine, I do my money. But if I double it in, like Tom, you were talking about, double it in a week, it's like, take some money off the table, right? Because that's not going to keep happening week after week.
Yeah. Well, I think even bringing it back to that time theory and incentives, even the theory now can be seen as noise. There's just the amount of people saying, put it in the market, just put the cash in the market and sit there and forget about the down times, forget about the hard times, because it always keeps going up. There's so much noise within that, because it again ties in with the incentives to keep people in the market and to keep people buying, that the lines become really, really blurred of the incentive from the brokers, for example, to keep trading people's cash, and then the theory becoming noise, and people just go, it's too hard. It's just too hard. Yeah. Steve, look after my cash, and I'll ride through the hard times, and ultimately the industry just carries on winning.
Yeah, absolutely.
Well, sorry, Tom, did you want to say?
No, you go.
I just wanted to, if you think about, this is the sort of, here's what you should do part of the show. What you want to do is understand what your investment period is. A lot of the time, and I can tell you, even I get caught with it after 25 years. I'm buying this stock for 10 years. Whoa, look at that. It's gone up 50%. I'm a genius, right? And that is the hard part about the noise. The noise is constantly eating away at you emotionally to just do something, right? Or even just to say, should I be doing something? One of the benefits of property as an investment is you're able to say, well, I'm not going to, I'm not selling the back bedroom just because the price has gone up $100,000, or by even going, well, hey, my property went up 5% this week. Oh, I better think about selling.
Yeah, you can't check it.
Yeah. And so, but it's also illiquid, right?
Yeah.
And the transaction costs are high. And while you look at that and go, oh, that's a bit of a negative, if you buy property, right, at a good time, it's actually really beneficial that you can't do dumb stuff, right? Rather than, whereas in the stocks, you can click and immediately go, oh, I feel better. Either feel better that you sold or feel better that you bought. But it's like that sort of cocaine brain, where like you're a rat sort of hitting the bell to get the drink of, the sugar water stuff, right? Because there's so much information out there that, if I look at my own email list, I would probably have probably about 20 emails a day that I get from, different sources, right?
Wall Street Journal, ASX Journal, whatever it is.
Everything, fund managers, sites, trading platforms, ETF sites, all of that sort of stuff, which constantly makes me go, oh, I've got to read that. Oh, I've got to read that. Oh, I better read that. And now I'm much more like, actually, I don't need to read that because it's not going to make any difference. I invest the way I invest. I know that works, and that's what I'm going to run with. But even then, I'm still like, I think, Tom, we were talking about before about personality and going, like, for me, it's like, Steve, don't look at the market every day. It's like, dude, that's like killing me. I cannot do that. I have got to look at it every day, right? Or I got to read something. There's got to be some action. I could miss something, right? Yeah. But other people will say, oh, well, that's really stupid. No, I'm not bothered by that. Part of that is, but I'm in stocks, you're in, property, or you bought a vintage car. Well, of course you're not going to check it every day, right? So bringing that back to the point of, you've got to know your time frame. And if the idea, again, what you were saying before, Jacob, about theory and incentives, the industry always says, Jacob, you've got to think long term, right? 5, 10, 30 years. But we're going to talk to you every day, Jacob, about how the stock market moved, right? And it's like, but you just told me I'm investing. Yeah, but you got to be, you got to read all the news and keep up with the data. Yeah, but you told me according to the efficient market that none of that's valuable. Oh, yes, it is. No. So there's all these mixed signals about, well, do I ignore what's going on, or do I actually, should I act on that short-term technical indicator, even though I'm a long-term investor? And they're saying it's really dangerous. So, maybe I'll end up losing money. All of that stuff sort of plays in. And what we talked about last time is by looking at the signals, which we'll talk about soon, that again gives you the ability to be able to say, that's just noise.
Just objectively look at the situation.
I mean, yeah, like it does depend on your type, right? So for me, because of my type, I feel like I always have to be doing something. So part of my investment strategy, like I day trade as well. So I have a long-term portfolio, but I also day trade. So,
Not advice, folks.
it's not advice. It's definitely not advice, but it scratches that itch for me.
Yeah.
But so when I'm seeing these daily updates, it's irrelevant for my long-term strategy. But from a day trading perspective, I go, oh, cool, there's volatility there. I'm going to have a look at the charts there. And there might be an opportunity there for me today. Right. So again, if you've bought a stock, it's cheap. I'm going to hold this sucker for 5 years. I'm going to take my 10% compound off this one. You don't need to check it every day. In fact, you're better off not checking it.
Delete that whole thing.
Like Steve said. Absolutely. But look, we've spoken a lot about signal. Probably everyone listening understands how overwhelming all the contradictory information is out there. You've got the CNBC that'll push notifications to your phone all day, Facebook, YouTube. So let's talk about signals.
Well, just before we move on to that, if you think about the information that's out there, right, and I'll just, the ComSec and they all do it, they all put out here's what's coming up this week, right? And if I can just run through some of this, right? Tuesday, there's the weekly consumer confidence index, the monthly consumer sentiment, the NAB business survey. Wednesday, there's the speech by the governor, building activity, December quarter. There's business turnover for February, and there's housing spending indicator for February. Thursday, there's labour force, and Thursday, there's also overseas arrivals and departures, right? That's just in Australia, right? Now, overseas, there's US consumer expected inflation, US wholesale inventories, China inflation, US CPI, the Federal Open Market Committee, the federal budget, the US Producers Price Index, China trade, blah, 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 right? You get it? Now, first of all, you say, okay, that's a lot of information in 1 week. The next question is, okay, but is any of that really relevant?
Yeah.
Right? Rather than just saying, and you see this a lot in the media, right? Today, the consumer sentiment was 61 from last month's 59.4. And it's like, okay, so does that mean I should sell my stocks or buy my stocks? Or, should I get into retail stocks or should I sell out of it? And so, again, all this information comes down. First of all, you want to say, is it relevant? Second of all, you then want to say, well, is the producer price index more important than the consumer index? Is the unemployment rate really more important than the interest rate? You know what I mean?
What does it all mean?
Well, what does it all mean? And also, too, well, which one should I be looking at?
Yeah.
Right? Which is what you were saying a minute ago, Tom. What is the signal? And what you find is most of the signals have got nothing to do with economics, right? And for the reason of, again, if you look at the industry's predictive power, it's awful, right? It's really awful. Yeah. Now, I'm not saying, we're geniuses and we're better, but what I'm saying is the industry promotes itself as we know what's going on, we're experts. We talk about the economy, the fundamentals.
Fancy words. We've all got degrees.
Absolutely. And you go, Steve must know what he's talking about because he's on the news and he writes articles, right? And if you think back to 2007, at the top of the US market, unemployment was low, the economy was going really well, the housing market was doing really well. So in other words, you had all these indicators which you'd be going, things are fine. Things are really pumping along. We, on the other hand, talk about the signal, which is, for one, you can use the CAPE ratio, right? Really simple. It's there. You can look at it every week. It hardly changes much, but it's a really great signal, which is, and I'll just spend some time on CAPE, which is the cyclically adjusted price earnings ratio. Excuse me. What Robert Shiller said, again, signal and noise. The theory, efficient market theory, said the price is a true reflection of all the information out there at the moment, right? So if the stock market's at 7,000, that's the true sort of value, right? Now, we know that's not true. What Robert Shiller did was went back in history and said, all right, if it's connected to earnings, then the stock market should generally move in terms of earnings, right? Company earnings are really stable. They grow at 3 or 4% per year. Why does the stock market grow at 8 and 20 and then minus 50 and right all over the place? And what Shiller said was because it was all this behavioural stuff, right?
Human psychology.
And where does that come from? It comes from this constant stream of information and data, speculation, opinions, advertising every day about the stock market. And so that is really, really important because, again, when you come out with the producer price index said blah, 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 and the unemployment rate, blah, first of all, you've got to say, okay, but is that, I bought a stock and it's yielding 7%. Is that going to be anything for my stock? Probably not. Okay, well, I don't need to listen to it, right? And that's the sort of thing. But as you say, Tom, if you're looking for excitement, you tend to get, dragged in and, get seduced into doing stuff or buying more or, signing up for another email letter, all that sort of thing. And your day all gets taken away with this stuff of constantly reading information, but then getting to the end of the day and going, actually, that wasn't any value. Because you get the oil price on the money. Today oil fell $1 a barrel because we were worried about Chinese economic growth, right? Oh, Jesus, that's not very good. Tuesday, oil went up $1.50 a barrel because, there was a rebound about Chinese economic growth. Oh, okay, righto. Wednesday, our oil fell 45 cents a barrel today because of, blah, blah, blah. It's all bullshit, right? They've got no idea. Everyone just goes, mate, oil's fallen $1. What do you reckon? Oh, Chinese economic growth, mate. Yeah, of course, right. Okay.
That makes sense.
Well, you think about it. If you're a journo, and I'm not being rude, but you don't necessarily think, oh, geez, I better check whether that's actually true. I'm going to dial up 1 million global investors and see if that is true about the oil price. Right? Because that's the way you'd have to confirm it. You can't talk to one person. He goes, oh, yes, Chinese economic growth. Oh,
Must be
okay.
Right. Well, it's speculation, right?
Yeah, and your job is to get the article to the editor. No one's going to go, Steve, is that actually true? Because the first thing is tomorrow, mate, who cares? I'm writing a new article tomorrow about what happens in the oil price. Right? And all of that stuff is just noise. And that's what Shiller was basically saying. If you look at the data, the earnings growth is fairly steady. And if you do that, again, what we talked about last time with base rates is you can look back and go, okay, well, generally it's going to grow at about 3 or 4 or whatever it is, right? And that's why he has the CAPE ratio at a long-term average of 17, right? And at the moment it's 29 or something. What you do, if that's your signal, and it is for me, what you do is you have to say, okay, well, what's happened last time? It was 29. Oh, well, it was 29 in 2000. Oh, okay. And what happened there? Well, you lost 50%. Okay. It was 29 in 1929. Okay, what happened then? Okay, you lost 50%. Oh, okay. And what happened in 2007? It was 29. And what'd you do? And you lost 50%.
And what is it today?
29.
Oh, okay.
Right?
And what
But-
was it 6 months ago?
Yeah.
32.
But you see what I mean? Like
Yeah.
what you're doing is saying, Jesus, the track record at 29 is not real good. But the industry is saying, listen, Tom, you'll be fine, mate. Money in the market.
Efficient market theory.
You know, the producer price index, Tom, really strong. Really strong. You know, housing prices really strong. Credit growth is fantastic. Right? And you go, right, okay, of course, yeah.
Give me the
cool.
1%. Give me the 1% fee.
Yeah, but Robert Schiller's saying, look, over the next 10 years, it could go to 44, which is what it did in 2000. But we're just letting you know that your return is probably going to be not real crash hot. So maybe it's a better idea that you just park a lot of cash and wait for the market to fall. But again, the industry is sort of like, no, you know, you got to stay in. That's the way you build long-term wealth, right? And
Coming
it's,
back to not losing money, right?
yeah, and it's exactly, Tom, exactly.
Yeah. Well, yeah, if you're sitting there going, right, well, Cape's near 30, chances of me getting a good return here on out, very low. I'm going to de-risk a bit. I'm going to reduce my exposure.
Yes,
And like to your point, we don't know. No one knows exactly what's going to happen, what the catalyst might be. But if we're working off history and we're looking at our signals that suits our investment style, that's the point which we would start to look at de-risking.
absolutely. I mean, if you, and I'll just sort of summarise it a bit here for people. If you use the Cape ratio as a really simple indicator, and you say, yeah, I'm a, quote, long-term investor for 10 years, that will correlate with returns 100% better than any person in the industry will tell you, right? Because the Cape has a long history. It ranges from, 5 in 1982 to 44 in 2000. And during that period, you made 16% per year. Right, compounding. Now, here's the rub, right? This is the point that's really important. From 1964 to 1981, the US economy absolutely killed it, right? The stock market, the Dow Jones, went nowhere, right? So from 1982 to 2000, the stock market had the best bull market it's ever had. The economy didn't do, I think, it was not miserable, but it was nowhere near as good as it had been. So what I'm saying there is there's all these people talking about the economy and the stock market's not going anywhere. Then there's all these people talking about the stock market and the economy's not doing much. And again, one of the points we'll talk about in a future podcast is saying the stock market's not the economy, right? So, but my point being that information is the lifeblood, it's currency. You need some information. And we talked about this right in the first show where we said the critical thing is what information, which book is a good book to read, right? And it's not a book that tells you all about the daily noise. It's a book that says, here are some investment principles, which is what we're talking about, right? Which is, look, don't focus on the noise. Do focus on the signal. What's the signal? Okay, you can use something like the Cape ratio. You could use something like the earnings yield, right? And these things are really, really simple as a way to say, look, if you're investing for the long term, i.e. what the industry want, well, there are times where you say, this Cape thing is at 10, what's it done when it's at 10? Oh, the returns have been fantastic. Oh, okay, well, probably a good idea.
Put some in.
Probably a good idea to put some money in. When do I take it out? When the signal is at,
29.
It's exactly right, right? Or at least say, listen, I've been having a party. Like Tom said, 2009 to now, you've made like 500%. Probably a good idea to take some dough off the table, right? When you look at history. So it's not us three here going, we've divined the future and we think you should take money off. All we're doing is say, listen, according to history, you're probably going to lose a fair bit of money.
Yeah.
And why? Well, because the market gets really carried away behaviourally and then it gets really carried on the downside. So if you can understand that, and manage your portfolio accordingly, the daily, weekly, monthly chatter shouldn't mean anything, towards your returns or influence your decisions.
Yeah.
So
I think what we're saying is as well, we've been through that psychological warfare and figured out we've had to sit in the noise for so many years that we found signals that it's easy to say, okay, this is the noise, that's all good and well, and there might be a few fundamental points in there where you go, I really like that information. How does that relate back to my signals? What are my signals saying? Because then that allows me to make a decision.
Yeah.
So like the CAPE ratio, like that old Buffett saying, buy when everybody's selling. There are some really key fundamentals, and the man's been around since Jesus was a boy, and he's made a lot of cash.
Yes.
So understanding, am I being psychologically manipulated by the noise?
Yes.
What questions do I need to ask myself so I can make a sound decision?
Absolutely. And go look into the CAPE ratio.
Yeah.
Good yardstick
100%. But it's but in all seriousness, it is that simple. When if you remember, we talked about in the second one, we talked about, if I made you an offer and said, Jacob, I'll offer you 11% compound per year. Or in 1982, I said, listen, Jacob, I don't know, but you'll probably do all right if you invest money now because it's really cheap, right? And you, without knowing anything, like a lot of people in 1982, made a lot of money. And they did because the market was cheap. So it wasn't anything about, I'm a genius and I've read 400 Warren Buffett books, and I know how to. It was simply saying, listen, mate, everything's cheap. If you buy stuff, you'll probably do really well. Mm-hmm. The thing we do focus on probably more than others is about selling, right? Is about saying, Tom, you've made 500%, probably a good idea to take some money off the table. And that's where the industry comes back with, no, Tom, you've got to leave it there to compound over the long term. And that's not relevant to everybody, because if you said, but I'm retiring in the next 2 years, it's like, okay, you really should take 450% off the table, right? Rather than say, oh, you'll be fine, Tom, for another 12 months. Because as you know, markets can move really quickly. And when they start to fall, the industry flips the switch to then talking about, well, you've got to stay in the long term. I mean, I saw this during the COVID stuff, right? Mm-hmm. The market dropped 35% in a month, and suddenly we were all talking about the long term and, you've got to stay through these hard periods. And the answer will be, well, yes, Steve, but it rebounded 35 the next month. And it's like, that was one possible scenario. Mm. But my point being that the industry changes the focus when the market changes. So on the way up, you can't get in enough and put enough money in the stock market. When it falls, it flips to, you got to focus on the long term, right? And stocks are about the long term. And it's like, well, why the hell are you telling me every day what the oil price is, right? So it's just those sort of things. So look, we might leave it there, and we'll continue on in the next session.
Yeah.
And I think we've got one or two more to do with incentives, and then we'll move to the next theme. But as always, none of this is financial advice. And as always, if you've got a question or anything you want to shoot to Tom and Jacob or myself, please drop us a line. We're happy to chat to you. We'll see you next time.
See you next time. Cheers.
Thank you.
That's it for another episode of Stock Market Mentor. We hope you have enjoyed the show, and if you have any questions about the episode or want to discuss how we can help you become a better investor, please feel free to contact us at support@stockmarketmentor.com.au. We'll see you next time.